how to choose the right trading strategy for you. So before we get started, make sure to hit that like button. Also subscribe to my channel. Options can be used to implement a wide array of trading strategies, ranging from simple buy and sells to complex spreads with names like butterflies and condors. In addition, options are available on a vast range of stocks, currencies, commodities, exchange-traded funds, and futures contracts. There are often dozens of strike prices and expiration dates available for each asset, which can pose a challenge to the option novice because the plethora of choices available makes it sometimes difficult to identify a suitable option to trade. Finding the right option. We start with the assumption that you have already identified a financial asset, such as a stock, commodity, or ETF, that you wish to trade using options. You may have picked this underlying using a stock screener, by employing your own analysis, or by using third-party research. Regardless of the method of selection, once you have identified the underlying asset to trade. Option objective. The starting point when making any investment is your investment objective, and options trading is no different. What objective do you want to achieve with your option trade? Is it to speculate on a bullish or bearish view of the underlying asset? Or is it to hedge potential downside risk on a stock in which you have a significant position? Are you putting on the trade to earn income from selling option premium? For example, is the strategy part of a covered call against an existing stock position? Or are you writing puts on a stock that you want to own? Using options to generate income is a vastly different approach compared to buying options to speculate or to hedge. Risk-reward? The next step is to determine your risk-reward payoff, which should be dependent on your risk tolerance or appetite for risk. If you are a conservative investor or trader, then aggressive strategies such as writing puts or buying a large amount of deep out-of-the-money (OTM) options may not be suited to you. Every option strategy has a well-defined risk and reward profile, so make sure you understand it thoroughly. Check the volatility. Implied volatility is one of the most important determinants of an option's price. So get a good read on the level of implied volatility for the options you are considering. Compare the level of implied volatility with the stock's historical volatility and the level of volatility in the broad market, since this will be a key factor in identifying your option trade strategy. Implied volatility lets you know whether other traders are expecting the stock to move a lot or not. High implied volatility will push up premiums, making writing an option more attractive, assuming the trader thinks volatility will not keep increasing, which could increase the chance of the option being exercised. Low implied volatility means cheaper option premiums, which is good for buying options if a trader expects the underlying stock will move enough to increase the value of the options. Identify events. Events can be classified into two broad categories: market-wide and stock-specific. Market-wide events are those that impact the broad markets, such as Federal Reserve announcements and economic data releases. Stock-specific events are things like earnings reports, product launches, and spin-offs. An event can have a significant effect on implied volatility before its actual occurrence, and the event can have a huge impact on the stock price when it does occur. So do you want to capitalize on the surge in volatility before a key event? Or would you rather wait on the sidelines until things settle down? Identifying events that may impact the underlying asset can help you decide on the appropriate time frame and expiration date for your option trade. Devise a strategy. Based on the analysis conducted in the previous steps, you now know your investment objective, desired risk-reward payoff, level of implied and historical volatility, and key events that may affect the underlying asset. Going through the 4 steps makes it much easier to identify a specific option strategy. For example, let's say you are a conservative investor with a sizable stock portfolio and want to earn premium income before companies commence reporting their quarterly earnings in a couple of months. You may therefore opt for a covered call writing strategy, which involves writing calls on some or all of the stocks in your portfolio. As another example, if you are an aggressive investor who likes long shots and is convinced that the markets are headed for a big decline within 6 months, you may decide to buy puts on major stock indices. Establish parameters. Now that you have identified the specific option strategy you want to implement, All that remains is to establish option parameters like expiration dates, strike prices, and option deltas. For example, you may want to buy a call with the longest possible expiration, but at the lowest possible cost, in which case an out-of-the-money call may be suitable. Conversely, if you desire a call with a high delta, you may prefer an in-the-money option. Since the investor wants to hedge the stock position past earnings, they buy the 3-month $165 puts. The total cost of the put position to hedge 1,000 shares of MCD is $7,150, $7.15 x 100 shares per contract x 10 contracts. This cost excludes commissions. If the stock drops, the investor is hedged, as the gain on the put option will likely offset the loss in the stock. If the stock stays flat and is trading unchanged at $161.48 very shortly before the puts expire, the puts would have an intrinsic value of $3.52, $165, $161.48, which means that the investor could recoup about $3,520 of the amount invested in the puts by selling the puts to close the position. If the stock price goes up above $165, the investor profits on the increase in value of the 1,000 shares, but forfeits the $7,150 paid on the options. What do you think about our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.